Show me the money. This is the Moneyweb Be a Better Investor podcast, picking the brains of professional investors on their investment strategies, successes, and mistakes. Your host, Ryk van Niekerk.
Welcome to this week's edition of the Be a Better Investor podcast. My name is Ryk van Niekerk, and in this podcast series, I speak to leading professional investors about their investment journeys. We try to understand how they analyze investment opportunities, what companies and assets they invest in, and whether they have more hits than misses. And the idea is to identify a few golden nuggets of wisdom to help amateur retail investors to become better investors. My guest today is Asanda Notshe. He is the Chief Investment Officer at Mazi Asset Management, and he has been in the investment business for 2 decades. He's an actuary and began his career as an actuarial analyst at Alexander Forbes Financial Services. Before joining Mazi, Asanda worked at Stanlip, where he headed up the product development division. And he has been at Mazi for 14 years and has worked in many roles there, including being a senior portfolio manager, a research analyst, and a member of the executive committee. Asanda, thank you so much for your time today. First of all, tell us about your background. Where did you grow up and what were your career dreams when you were young?
Thank you very much, Ryk. Appreciate the opportunity. So I grew up in Durban. I was born in a township called Hammersdale in Mpumalanga, which is kind of on your way to between Durban and Pietermaritzburg. I went to school there and then subsequently went to high school, Durban High School, DHS, and then went to university at UCT to study actuarial science. So career-wise, to be honest with you, the access to information just around careers, different opportunities was not readily available. And so to say to you, I knew exactly what I wanted to do, probably would be a lie. I wasn't really clear. I think fortunately for me, I was not so bad at counting and maths and so on. So my path led me towards actuarial science. I'll be very honest with you. When I started doing it, I had no clue what it was about. They just told me that you needed to get a certain mark in maths and English and get a certain number of points. And, there was a promise of it being a relatively okay paying job. So that's what I ended up doing. Luckily for me, and I'll say I'm very fortunate that it ended up being actually the thing that if I had the knowledge, I would have probably chosen anyway. So quite fortunate in that regard.
Yeah, normally the road of an actuary leads to the insurance industry. But obviously you ended up in the investment industry. When were you first exposed to investments?
So I think, if I just look back, my grandfather and my uncles used to run what they call a general dealer in the township, maybe just a shade bigger than a spaza, effectively, in today's terms. So, I would observe that. I guess it wasn't an investment per se, but I sort of recognized that the whole idea was really to invest in stock and then take that stock and sell it at a profit or slightly higher than what you bought it at and, generate a profit. So I think I'd say there was probably a bit of exposure there. And that piqued my interest in terms of that space, but I didn't really know that in a formalized way that's investments. I think where things got interesting for me was, you mentioned the actuarial science. In a funny way, I think that's actuarial science is almost misdiagnosed in terms of what it actually is, because it is about trying to figure out and understand whether it's trends, understand things that are into the future to make investment decisions, such as making assumptions about investment opportunities. So when I started at Forbes, I think looking at a pension fund, you've got assets and liabilities. As a actuarial analyst, you focus a lot on the liabilities in terms of trying to quantify those, understand how they would look into the future in terms of mortality and morbidity and things like that. That was fine for the first 2 years, but after the third year, you're checking your own work and you're updating everything you've done. Then I looked and observed the asset side of things, and where I could see, okay, guys are making investments to now match these liabilities, and they are making those decisions in a world that's ever evolving, different types of asset classes and opportunities. And that was really kind of where I think my interest really picked up. And that is actually part of the reason why I made the switch from, I guess I'd say, from the liabilities to the asset side of things.
When did you buy your very first share? And this is important, with money you've earned yourself, because sometimes it makes that decision quite hard.
Yeah, absolutely. So I remember quite clearly it was 2010, so I was a bit late in getting involved. So dipping my toe, but at Mazi and still ran hedge fund portfolio. So I bought, I was long Sanlam and then shorted Santam. So the idea really is to say, look, I think Sanlam will do a lot better than Santam. So to accentuate that opportunity, you sell some of the thing that you think is not going to do as well, and you use that money that you've sold or you've realized to buy more of the thing that you think is going to go up. I must say I didn't do too well on that trade, so maybe not a glowing sort of a situation there, but that was really my first dipping my toe with money that I've earned.
But that's a very, very interesting trade, because I don't think I've ever heard of any professional investor whose very first investment included a short position on a share. Why did you also include a short position in addition to the long position on Sanlam?
I probably shouldn't have, Erica, to be honest with you. But because I think in terms of just the investment approach at Mazi, and I guess I've adopted that as well as a personal investment approach, is that we look at, and the thinking there at the time anyway, was that we look at opportunities on an objective level. So we're trying to figure out what is the value, or what is the intrinsic fundamental value of an opportunity, and then saying, where's the opportunity in that? So unlike maybe, let's say, a long only investor where you are buying and you're holding, at Mazi, some of our portfolios do have the opportunity to benefit from things that actually go down. And so the thinking then was really to say, okay, I think this one in the form of Santam probably won't do as well, maybe might fall. So if it does, then I benefit because I've then taken a short position. And then in the opposite, I think Sanlam does better. But conceptually, the thinking was to say investments are, in our world anyway, in our thinking, it's really trying to be objective about the nature of the opportunity, not to get emotional or not to get like, almost unreasonable in the way that you assess. And, looking at hedge funds, you really need to apply yourself in that way.
Yeah, when you take a short position, it means that you expect or foresee, or in many cases hope, that the share price would decline, and you can make money from a declining share price. And conversely, if you go long on a share, it means that you believe the share price will rise. And I think the shorting of shares is not really an option for amateur retail investors, is it?
Yeah, it is a bit tricky for amateur retail investors just because of the structures involved, the capital that one would need to have. I think there are emerging sort of opportunities in terms of some of these derivative type products that they call CFDs that banks and the like and stockbrokers would offer. I think, though, for an amateur investor, from that perspective, I always kind of make the analogy of somebody who, let's say, runs a bank or is a mechanic or is in the trade, where you can come along as a client of that particular person and try and do what they do yourself. The reality, though, is that they do that on a daily basis. So I would probably say, to that point, Rick, I wouldn't necessarily advocate for going into the depths of shorting and so on, but rather maybe keeping it relatively simple in terms of taking a position on things that you think are going to do well for whatever the reason, and where perhaps you've got, I'm going to say, a limited amount of money that you can lose. So maybe to just go into a bit of that detail and just for the benefit of the listeners, with the short position, you can start by, let's say you sell a share at 10 Rand. And of course, you're hoping that it goes down. So you sell the share, so you borrow it from someone who owns it, and you sell it, and you get the 10 Rand. Now, if things go well, that share price goes down to 5 Rand. And so you use some of the 10 Rand that you got to buy it back. So you buy it at 5 Rand, you give it back to the person who had given it to you or who had borrowed it to you, and then you keep the 5 Rand. So now that's if it goes well. Conversely, and why, it's something not to get too exuberant with, is that if the opposite happens, so if that share price starts to go up, so 15 Rand, 20 Rand, 25 Rand, 30 Rand, you then have, I guess, an increasing loss that is arising because you only have 10 Rand in terms of the position or the shares that you sold initially. But now, to give that share back to the person, you're needing to pay a lot more than the 10 Rand that you initially received when you sold. And so that's why, with the going short and so on, they typically say that there is an opportunity for unlimited loss. Because if that share, for whatever reason, goes up to 100 Rand, 1,000 Rand, who knows? Effectively, your exposure is unlimited or uncapped. Whereas, if you buy a share, you think it's going to go up. If it doesn't, the worst that can happen is you lose your 10 Rand, let's say, if you had invested 10 Rand in a particular share.
Yeah, it's very, very risky, and you need to know what you're doing when you dabble in CFDs and other derivative products. But subsequent to that first trade, did your investment approach change?
Well, I think one learns a lot by doing, and I think what's happened to me is I've been in the space for a long time, and I think one learns a lot. The approach hasn't changed. I still, focus on a personal level, and I think as Mazi, focus on understanding businesses at a fundamental level. So what does the company do? Who are its clients? Who are the competitors, suppliers? Who regulates that particular company? What is its strategy? Is it sustainable? Who manages that company? And so putting all of those sort of aspects together, one can really paint a picture of what it is that the company does and its prospects going forward. And I think for retail investors, it is one of the things that I would probably advocate for in terms of investing in things that you've got a fairly good understanding of. So it does maybe require taking a bit of time, doing some reading. It's one of the really fun bits of what we do because we get to learn about a lot of different things. So we can have a good conversation about a retail company, a mining company, a bank, a logistics company, a tech, telecoms, all across the board because of, I guess, the work that we do. But yes, same investment approach in terms of really focusing on and understanding or taking the time to understand investments at a fundamental level and then making an investment decision based on that understanding.
Yeah, that's a thorough investigation or research effort on a particular company, and as an actuary you can understand the numbers quite easily, and then you complete the picture with some external information regarding the quality of management, etc., etc. But not all amateur retail investors, as you've just said, have the time and ability to do that. And that makes it sometimes very, very difficult for these investors to make money, and they become disheartened whenever they take a decision, mostly based on emotion and a gut feeling at a young age, and that's how they get into the market. So put yourself in the shoes of, say, a young lawyer who's not in the financial services industry, who want to get into the market. How do you think they should approach it?
Rick, I'll take a slight one or half a step back and say, I always say to people, before you invest, I think it's very, very important to understand your financial position. So as a start, I'd say, look, if you've got debt, for instance, invest in your debt, i.e. that's a guaranteed return because you get to save the interest. But I'm maybe talking more at a conceptual level around just financial planning, understanding where you are, and also understanding how much you should be investing given your overall picture. Okay, so let's park that. So now you've determined what it is that how much you're gonna be investing. I think as a retail investor, then what one needs to do in going about investing is firstly, I think, give yourself time horizon. So you kind of say, look, I've got a particular goal perhaps that I'm investing towards. I think that's also an important aspect of it. So I want to save for a deposit on a house. In 5 years' time, I want to be in that position and I want to start now. That, I think, gives you a really, really good starting point in terms of saying, I've got this amount of time. So the things that I'm going to invest in, I'm going to really give them the opportunity to do the work for me because I've got that amount of time. I think secondly then is, I think, to identify perhaps, either people, companies that you perhaps think have got the know-how that you can then look at and work with in terms of getting information. So you might then say, look, I'm going to, read And sorry, Rick, I'm going to put in a bit of marketing. Yeah, you're going to read Mazi's quarterly newsletter, for instance, and sort of pick up what it is that they're saying, and of course any other company. But then, using that, and you are now sort of affiliating yourself with, professionals, people who do this on a daily basis. But I think, yeah, doing that then maybe gives you targeted information about where opportunities are. In addition to that, of course, podcasts such as yourself and other publications. So yes, you're not going perhaps into the depth that we may in terms of how we go about investing. But I think you do need to give yourself a chance and educate yourself in a way that is reasonable and is accessible. And I think a lot of companies at the moment are putting out information, content, and so on. And so I think that's a really good starting point. And then I guess a third step would then be to really try and focus your investing on maybe things that resonate with you in terms of what you understand. Look, there'll be many, many, many investment opportunities. Some may look more attractive than others. I think it's always comforting and also helpful in terms of managing your emotions. I think you noted that quite rightly. It's always helpful if you're investing in things that you clear. So let's say you've invested in a telco's company. Now you hear, MTN, for instance. Now you hear, oh my gosh, in Nigeria, the Naira and the currency is devaluing and the company's not going to do so well. If perhaps you had read something and that resonated with you, which said, look, the opportunities for MTN in Nigeria are X, Y, and Z, maybe then, given that you've got a 5-year, 10-year investment horizon, you look through that and not necessarily sell at the worst time because of fear and those emotions. So I think really basing yourself on some sound basis and fundamental kind of knowledge is always helpful.
So what you're saying is read, and take note of what
listen.
Professional investors say. And listen, obviously, and I think it's excellent advice. And I think many professional investors do air their views on news platforms regularly. And it's always easy to listen to those. And it's always good to know you listen to the best type of professional investors. But one thing I come across often is that young investors, they still react to a hot tip. They would stand around a braai and then they listen, the next big thing is going to be, say, MTN, to use your example. They're about to do a big deal. And of course, in the modern era of investing, such information is not really freely available. There are very strict rules about it. But would you or did you react to a tip, for example, in the past? And how would you advise young investors to act when they actually get a, in quotation marks, a hot tip around the braai?
Yeah, look, I think that's always very tempting because there's kind of a FOMO feeling to it where you don't want to miss out on something and you perceive to be inside information, if I can use that term, but really, information that's going to enable you to kind of advance yourself and do better than others. I think maybe the same, let's say, a suggestion would apply in that case as well is, there's always maybe two sides to a story or further information that's available on a similar topic. I would say, look, I think you may want to corroborate perhaps the information that you've received in some shape or form. So again, maybe looking through the internet and seeing if there's anybody else who's maybe speaking about a similar topic. Now, granted, if it is a hot tip and maybe information that's not freely available, there may be, I guess, some caution that one wants to exercise simply because, in terms of the way that markets work, we've got the regulator in the form of FSCA and the JSE who are looking at and observing whether, people are acting on information that they're not supposed to have and supposed to know. So I think there is some caution around those types of things that investors need to be aware of in terms of just the regulations and the way that things work, and really why that is there. And one might say, well, I mean, if I'm savvy enough to mix with the right people, rub shoulders with those people, then I should be able to act on that information and give myself a leg up. The reality is that for all the other investors who are on the opposite side of that information, you might be one of those as an investor in another instance where somebody else has got a leg up. The reality is that these companies, especially listed companies, are public companies. Them being public companies, they have a duty to make information available in the same way for everyone across in the market. And so having a hot tip might be, exciting in one instance, but, it might actually be a problem for you in another, in that you're not actually allowed to know that information. So I think, really being careful, trading very carefully around that information, it would be advisable. As I said, corroborating maybe and checking whether is this something that's really out there? Do other people know about this? And perhaps then using that as a guide in terms of whether one should act on it. But I'd say also, applying the principles that I mentioned earlier, where you say, does this make sense? Is it something that, let's say it is out there, maybe it's not acted on, or people are perhaps skeptical. Is it something that's going to move this investment forward? If I apply my mind, does this make sense? So really being practical about it. At the end of the day, even professional investors, we're all human. So it's not like, yes, we do this on a daily basis, but we're also sometimes susceptible to, those emotions and so on. So somebody might say something, out of turn in a conversation, and, you don't really want to take that with its emotions and act on it, but rather corroborate it. Yeah.
The core message there is be careful. And if you hear it around a braai, you're definitely not the first to hear it. So I think the message is quite clear there. Just lastly, what has been your best investment ever? And I'm talking about in a personal capacity, one you are the most proud of.
Wow. So, it was in 2012. I went to a lunch, one of these lunches with companies where you sort of have an opportunity to engage with company management, and it was with Koos Becker. So, at the time, I think Naspers was probably trading at like 300 Rand, 200, 300 Rand, somewhere there, maybe even 400 Rand. He then gave sort of insights into what they're doing, how they're trying to benefit from the opportunity in China. And I think that resonated with me. So I came back to the team and I said, guys, look, I think, I didn't understand maybe 60% of what the guy said, but the 40% that I understand, I think is definitely worth exploring. So we did a bit of work on it, and we invested. And I also invested on a personal basis. And I think that's been a fantastic investment. But again, maybe I'd say and again, you'll never know everything about a company, but really trying to use and benefit from the fundamental views or fundamental sort of information about the company. And that's been a good one.
Do you still hold those shares?
I don't anymore. I think at points in time, I think the company's done quite well, and, felt that there was at a time an opportunity to then sell when I felt that the share price had gotten to a level where, it maybe reflected what is fair in terms of the value of the company, and then pursued other opportunities thereafter. And
your worst investment ever? Which has been the biggest dog you bought?
I'd probably say that investment, that position that I took in the Sanlam Santam was probably the worst thing I'd done, because I lost money on that. Probably ill-advised in terms of doing it, as I said earlier. Yeah, I think that was probably one of those. I guess along the way there's been one or two others that haven't done so well, but I think nothing that, I'd say I've lost money on, sort of like wildly, as it were. But yeah, I'd probably cite that first one. So yeah, maybe the first one was the school fees, as it were.
Well, it's good if your worst investment was your first investment, because it means that all your subsequent investments weren't that bad at all. But we'll have to leave it there. Asanda, thank you so much for your time and for sharing your insights with us.
Thank you very much for the opportunity, Rick, and all the best. And thank you, and regards to the listeners.
Thanks, Asanda. That was Asanda Notshe. He's the Chief Investment Officer at Mazi Asset Management.
Show me the money. That was the Moneyweb Be a Better Investor podcast with Ryk van Niekerk. Thanks for listening. Catch up and listen to all the Moneyweb podcasts on moneyweb.co.za or the app. Moneyweb, your trusted source for business and investment insights.